Welcome back to The Ledger, the show where we try to make sense of the dollars and cents in your pocket. I'm Joe.
And I'm Gene. And wow, Joe, happy almost New Year. Can you believe we are essentially staring down the barrel of 2026?
It has been a blur, Jane. Honestly, looking at the charts this morning, Dec 30th, 2025, it feels like the market is trying to cram a whole decade of volatility into the last week of the year.
Tell me about it. I was scrolling through X this morning and my feed is just a wall of red and green candles. I saw a headline from Bloomberg about liquidation cascades in Bitcoin futures, and then another one from Yahoo Finance about S&P 500 futures hitting weird highs despite the Fed minutes. But the word I keep seeing over and over again is leverage.
That is the magic word, Jane. Leverage. It is the engine under the hood of the global financial system, but especially in the futures market. It's the reason why a boring news headline about tariffs in South Korea can suddenly wipe out a trader in Chicago in 3 seconds flat.
Okay, so that's what I want to understand today. I know leverage means using debt or something, but how does it actually work in futures? Like, how does it give us the superpower to make money, and why is it so dangerous? Because I saw a post about a guy losing his whole account in that Bitcoin drop yesterday.
A classic and tragic tale. To understand that guy's pain, we have to start with the definition. In the futures market, leverage is the ability to control a large contract value with a relatively small amount of capital. We call that capital margin.
Margin. Okay. Is that like the down payment on a house?
That is the perfect analogy. Let's stick with that. Jane, imagine you want to buy a house worth $500,000. Do you usually pay $500,000 cash up front?
In this economy? No way. I'd put down maybe 10%, so $50,000.
Exactly. You put down $50,000, which is your equity. The bank lends you the rest. But here is the key. You get to live in the entire house. If the house value is up to $550,000, that's a 10% increase in the asset price. But you, Jane, you put down $50,000. Now your equity is effectively $100,000, your original $50K plus the $50K gain. You just doubled your money, a 100% return on just a 10% move in the house price.
Wait, let me do the math. 50K down, the house gains 50K, so now I have 100K of value that belongs to me. Yeah, that's amazing. That's why people say real estate builds wealth.
Correct. That is leverage at work. Now, take that concept and put it on steroids. Remove the house, replace it with a contract for 1,000 barrels of crude oil or a basket of S&P 500 stocks, and speed up the transaction time from 30 years to 30 milliseconds. That is futures.
Okay, that sounds intense. So in futures, I'm putting down a down payment to control what exactly?
You are controlling the notional value of the contract. Let's look at the E-mini S&P 500. It's one of the most popular futures contracts in the world. The value of one contract is $50 times the S&P 500 index price. Right now, the S&P is trading around, let's call it $6,000 for easy math.
Okay, so $6,000 times $50, that's $300,000. So one contract is worth $300,000 of stock?
Spot on. Now, if you wanted to buy $300,000 worth of actual stock, like buying all the Apple and Microsoft shares yourself, you'd need $300,000 cash, or maybe $150,000 if you used a traditional stock margin account, which gives you 2-to-1 leverage.
Right. Stock margin is usually 50%. I remember that from your last episode.
But in futures, the exchange, say the CME Group, might only require you to put up an initial margin of roughly $12,000 to $15,000 to open that trade, sometimes even less for day trading.
Whoa, wait, $12,000 to control $300,000? Let me check my calculator. That's like 25-to-1 leverage.
And that's conservative. In the crypto futures markets we saw yesterday, people were using 50x or even 100x leverage. But sticking to the S&P, yes, with $12,000, you control the gains and losses of a $300,000 portfolio. This is the financial crowbar.
The crowbar? Is that a technical term?
It's a physics analogy. Archimedes said, "Give me a lever long enough and a fulcrum on which to place it, and I shall move the world." In trading, your capital is the force you apply. The leverage ratio is the length of the crowbar. A small push, your $12,000, can move a massive object, $300,000 position, if the S&P 500 goes up just 1%.
Okay, 1% of $300,000 is $3,000.
Right, you make $3,000 profit. But remember, you only put down $12,000. A $3,000 profit on a $12,000 investment is a 25% return in one day, maybe in 1 hour.
I see the appeal. That's huge. If I just bought the stocks with cash, I'd only have made 1%.
Exactly. Leverage magnifies your return on equity, ROE. It makes capital efficient. You don't need to tie up $300,000. You can keep the rest of your money in treasury bills earning 4 or 5% and just use a tiny slice to get the market exposure. That's how the pros do it.
But Joe, we started this by talking about a guy who got wiped out. The crowbar can swing back, right?
And when it swings back, it hits you right in the teeth. Let's look at the dark side. Suppose the S&P 500 drops by 1%.
I lose $3,000.
Correct. Your $12,000 account is now $9,000. You lost 25% of your money on a 1% ripple in the market. Now, what happens if the market drops 4%? That's not uncommon. We saw a 4% drop earlier this year when the inflation data surprised us.
4% of $300,000 is $12,000. Oh no.
Oh, yes. You have lost your entire initial margin. You are at zero. But actually, it happens before you hit zero. This brings us to the most terrifying 2 words in trading: margin call.
I've heard horror stories. Walk me through the mechanics of that. Does a guy actually call you?
In the old days, maybe. Now, it's an algorithm, and it doesn't call, it just executes. You see, there are 2 types of margin. Initial margin is what you need to open the door. Maintenance margin is what you need to keep the door open. Usually, maintenance is a bit lower, maybe $10,000 in our example.
Okay, so if my account drops from $12,000 to $9,000.
You are below the $10,000 maintenance line. The broker's computer instantly flags your account. You have 2 choices: wire more money immediately, and I mean within minutes in volatile markets, or the broker liquidates you. They sell your contract at the current market price to protect themselves. They don't care about your long-term strategy. They care that you can cover the loss.
And that liquidation, that's what causes those wicks on the chart, like a sudden spike down.
Precisely. And this segues perfectly into the news from yesterday, December 29th, 2025. Did you see the Bitcoin chart?
Yeah, it looked like a cliff dive. Bloomberg said $370 million was liquidated.
Right. So here's what happened. Bitcoin was trading high, and traders were feeling confident. They went long, betting it would go up. Many were using high leverage, maybe 50x. That means they only had 2% margin down. A 2% drop wipes them out.
And crypto moves 2% in like a sneeze.
Exactly. So a small piece of bad news hit. Rumors about a new regulatory crackdown in the EU. Price dipped 2%. Those 50x leverage traders hit their liquidation price. The exchange's computer automatically sold their Bitcoin to close the position. Now, Jane, when you sell, what does that do to the price?
Selling drives the price down further.
Bingo. So the price drops more. Now the 20x leverage guys get hit. The computer sells their Bitcoin. Price drops more. Now the 10x leverage guys are sweating. It's a domino effect or a liquidation cascade. That $370 million wasn't people panicking. It was robots force closing leveraged bets because the math said game over.
That is terrifying. It's like a trap door opening under the market. And it's not just crypto, right? I saw something about copper futures going crazy too because of Trump's tariffs.
Yes, classic commodities volatility. So earlier in 2025, we had the Trump trade thesis, tariffs on everyone, which usually means higher costs. Copper is an industrial metal. When Trump announced that 50% tariff on copper imports, but exempted refined metals, it caught the market off guard.
Caught them off guard how?
Traders had used leverage to bet on a price spike due to scarcity. They were long copper futures. When the exemption was announced, it meant there wouldn't be as big of a shortage as thought. Prices plummeted. Copper futures have high leverage too. A single contract is for 25,000 pounds of copper. If copper is $4 a pound, that's a $100,000 contract. The margin might only be $5,000. If price drops 10 cents,
You lose $2,500, half your money.
And copper dropped hard, so we saw massive margin calls in the commodities pits. This is why leverage is a double-edged sword. It gives you the power to profit from macro events like tariffs or earnings, but if you are wrong, you don't just lose, you lose fast.
So, Joe, if it's so dangerous, why does anyone do it? Why not just stick to ETFs? Is it just greed?
Greed is a factor for speculators, sure. But remember, futures weren't invented for day traders like us to gamble on iPhones. They were invented for hedging.
Right, the farmers and the airlines.
Let's look at an airline in late 2025. Jet fuel prices are volatile. The airline is terrified that oil will spike to $100 a barrel next year, ruining their profits. They want to lock in a price now. They buy oil futures.
Okay, so they are long oil.
Yes. Now, why do they leverage? Because the airline doesn't want to take $100 million of cash out of their operating budget just to buy oil contracts. They want to use that cash to buy planes or pay pilots. With futures, they can put down $5 million in margin to lock in $100 million worth of oil. The leverage allows them to hedge their risk without tying up all their liquidity. For them, leverage isn't about getting rich. It's about capital efficiency.
That makes so much sense. So for a business, leverage is a tool to save cash flow. For a retail trader, it's a way to amplify bets.
Exactly. And the trouble comes when retail traders use business tool leverage with Vegas casino risk management.
I like that distinction. So looking ahead to 2026, we have the Fed potentially pausing cuts in January. We have the AI tech boom still trying to figure out if it can monetize. How should a normal person look at futures leverage right now?
With extreme caution. Look at the micro contracts. The CME introduced micro E-mini futures a few years back. They're 1/10 the size of the big ones. Instead of $50 per point, it's $5 per point. A contract is worth $30,000, not $300,000.
So the leverage is the same ratio, but the dollar amount is smaller.
Yes, it allows you to dip your toe in without risking the house. If you are learning, you start there. And never, ever use full leverage. Just because the broker gives you 20-to-1 doesn't mean you have to use 20-to-1.
How do you avoid using it if the contract is fixed size?
By putting more money in your account than the minimum. If the margin is $1,000, but you put $10,000 in your account, your effective leverage is much lower. You can withstand a much bigger drop before getting that dreaded margin call. We call that deleveraging your position.
Smart. So don't redline the engine.
Precisely. The market in 2026 is going to be driven by these macro shocks: tariffs, Fed policy, AI earnings. Futures are the most direct way to trade those themes because they trade 24 hours a day. When news breaks in Tokyo, the futures move instantly. But you have to respect the crowbar.
I think I get it now. It's not just borrowing money. It's about the ratio of what I put up versus what I control. And that ratio works both ways.
You've got it. Just remember the lesson from yesterday's crypto crash. $370 million vanished because people got too greedy with the leverage. Don't be a statistic in 2026.
Message received. Thanks for breaking it down, Joe. I'm going to go check my account and maybe lower my leverage settings.
Wise move, Jane. Safe trading, everyone, and see you next year.